Oracle, ticker ORCL, traded as high as $325 this year. Today, the software infrastructure company sits at $118, down 64% from the top. That kind of drop for a company this size does not happen quietly, and the charts back it up. The relative strength index is sitting at just under 29, deep into oversold territory, while the stock trades well below both its 50-day and 200-day averages. A beta above 1.8 tells you this name swings harder than the broader market in both directions. Oracle builds the software and infrastructure that large enterprises run on, from database systems and cloud applications to the servers and networking capacity behind artificial intelligence workloads. That last part is central to what is happening right now. Look at the top line and the story looks strong. Revenue climbed from roughly $50 billion to $67.4 billion over 4 fiscal years, and earnings per share nearly doubled, moving from $3.07 to $5.83 in that same window. Operating cash flow followed the same path upward, reaching almost $32 billion. But there is a second chart that tells a very different story. Free cash flow, which was a positive $11.8 billion 2 years ago, flipped negative and then fell off a cliff to roughly negative $23.7 billion in the most recent year. The company is generating record cash from operations and still burning through cash overall, because it is pouring enormous amounts into building out infrastructure for cloud and AI capacity. That spending has to be funded somehow, and the balance sheet shows how. Total debt sits above $156 billion against equity of just $42.5 billion, a debt-to-equity ratio near 3.9. Cash on hand is about $31.3 billion, and the current ratio of 1.115 leaves a fairly thin cushion. Return on equity looks enormous at over 53%, but with leverage this high, that number is doing a lot of the work. On profitability, the core business still looks healthy, with a gross margin near 66% and a net margin above 25%. So this is not a business losing money on what it sells, it is a business choosing to reinvest aggressively. Now to valuation. The price-to-earnings ratio sits at about 20.3, and the PEG ratio, which weighs that against growth, is a low 0.68, meaning the market is not charging a huge premium for the growth it is delivering. Compare that to peers. SAP trades at a PEG of 1.27, ServiceNow at 0.83 with a price-to-earnings ratio above 60, while Salesforce sits close by at 0.65. On that measure, this stock looks reasonably priced relative to its own growth, even after the crash. Whether that combination, strong growth, heavy cash burn, and high leverage, adds up to a buying opportunity or a warning sign is exactly the kind of judgment call that depends on your own risk tolerance, and it is not something I am going to tell you how to make. What is clear is that this is a company in the middle of a massive bet on AI infrastructure, funded by debt and operating cash flow, at a moment when the stock has already been cut roughly in half from its highs. If you found this breakdown useful, consider subscribing so you catch the next one. And before you go, drop a comment with the next ticker you would like broken down like this. As always, none of this is financial advice, just a look at the numbers, so do your own research before making any decisions.